So if you plot it, so I'm going to show you, see if I can find it. So this is in the Google Drive that you have access to. Where is it now? That, here we go. Okay. So this is basically the Google Drive that you have access to, right?
Yes.
Now these are the major topics. Where do I see the topics? Yeah. Okay. So these are the major topics. I mean, there's one or two or three topics I'm leaving out, but these are like the major, make up 80 to 90% of the paper, if not 100%. So now over here, yeah. So here we have the topics, right? Now all you do is you let's say we take a maximum of 5. You don't have to do 5, but we only allocate a maximum of 5. If you're doing more than 5, then obviously there's something not right, in a sense that if you need to do more than 5 because you're not feeling comfortable, then obviously fundamentally something's not right. Okay, then don't move on to a 6th question. Try to see what is the problem. Now there's maybe 2018, 2019. I think I loaded 2020 as well, I'm not sure, but definitely 2018, 2019. So there's 4 to 5 papers on the Google Drive as well. Then you just basically have a look which question paper covers these topics, and then you plot it. Then you can see from those 4 or 5 question papers, how many questions will it cover for each of these, right? Now, each question is probably like maximum 15, 20 marks. So you do one a day, basically. Each day, let's say you do activity-based, then whatever. So you literally spend 60 minutes to work whatever plan you come up with. You work, then you identify what you will do which day. Then below over here, you list the days remaining and the dates, and then you select what you're going to do each day. So for example, this is date, okay, and then you're going to have a question to cover. So now you have here you have your big picture plan for each topic, which question you're going to cover, which question paper. Now you're saying, okay, on Thursday, 4 November, I'm covering activity-based costing, and I'm doing May, June 20. So now, tomorrow, when you come, you do that question, literally 60 minutes. And you will see those small things over time grows. And then over a weekend, you can maybe do like 3 to 4 hours, where you maybe do one full question paper over a weekend. But remember, when you're doing this in the 60 minutes, this is a 20, say a 15-mark question. A 15-mark question won't take 60 minutes. But what you're going to do in the 60 minutes, you're going to try to mark yourself, see how can you where you're going right, where you're going wrong, and all of those type of stuff. Then that will automatically build the confidence within you. So maybe like, because I could see you know what you are doing, but maybe you are just stressing. So then you don't feel confident because you are stressing, but actually you know what you are doing. So yeah, so to build up that confidence, work through these questions. If you literally spend an hour a day, you'll be fine. And then weekends you push Saturday, Sunday, each day, Saturday and Sunday, 3 to 4 hours each, and you should be able to get through 5 question paper, 5 maybe. But remember, this is topic level, right? You need to do 1 to 2 question papers in full under time pressure. So you must set aside a question that you haven't covered before. That full question you must be able to cover and try to write within time. Okay, so just think about that. Okay, so Michaela said she can't join at the moment. So what I'm going to be doing now, I'm going to switch over to, we're going to be covering transfer pricing. Okay. I was going to see, where is this now? Okay, so this is going to be transfer pricing. So we're gonna cover transfer pricing, and so I'm gonna do a theory question on I'm gonna do from a theory perspective transfer pricing, and from a theory perspective performance management. Okay, then your homework is going to be for you to go and do a transfer pricing question, and for you to go and do a performance management question. Okay, I will select the question. I'm going to select it by tomorrow, and then I'm going to give it to you to cover. And then if there's any specific questions that you may have, then we set up that 15-minute sessions. Okay, so I'm not going to cover a particular question. I'm going to cover the theory as well as how to go about answering a question. Then I want you to take this. If you need to rewatch it, you rewatch it, but then you need to take it and try to answer a transfer pricing question and a performance management question. Okay, so you can see this, the screen. Yes.
Yes, yes, I can.
Okay. So now for transfer pricing, I mean, there's many things happening in transfer pricing. Many things happens in transfer pricing, but it basically comes down to what. So let's first understand, when does transfer pricing come into play? So how are you going to pick up that there's transfer pricing, potential transfer pricing in a question, is when you see you are busy with a company that runs a decentralized system, or a company that has divisions. So a decentralized system means that each division is responsible for themselves. Okay, so each division is accountable for themselves. So that is a decentralized system. A centralized system means as the company as a whole looks after everything, where a decentralized system is where a particular division is responsible and accountable for their own results. They get measured, the performance get measured based on their results and not the company as a whole. Okay, so for example, if you look at let's give an example. So, for example, if you look at Old Mutual, right, and probably Sanlam as well, they have different companies or different divisions or different departments. So, for example, they have an insurance department. They have a wealth a wealth department or company. I'm just going to refer to it as divisions, but remember, in reality, it could either be a department, it could either be a division, or it could either be a separate company as a whole. But basically, Old Mutual, what you see Old Mutual, the major company, but within Old Mutual, there are different divisions, departments, companies, right? So I'm like I said, I'm going to use the word division, whether it's a department, a division, or a company in reality. So they'll have an insurance division. They would have a division for high net worth clients. Then they have a division for what do they call it? Personal finance. So each division runs as a decentralized system, meaning as if they are an entity on their own. They get measured and the performance get measured based on that particular entity. Now, many companies run like this. Now, in situations like this, there may be overlap in the sense that one company provides products to another entity, another division within the same company, or provides services. So because they're running as separate entities, they will then transact with each other as if they are completely separate entities. Okay, so if you have a look at Coca-Cola, for example, they would have, let's say, the manufacturing division, and then they will have the bottling division. So let's say the manufacturing division is analyzed and measured based on how they operate. And similarly, the bottling division will be analyzed and measured based on how well they performed. Now, the manufacturing division requires bottles. So they may be buying bottles from the bottling division. So because they run as completely separate entities, the one will sell to the other. So the bottling division will sell their bottles to the manufacturing division. Now, the issue comes over here is that each division is responsible for themselves. As a result, they would want the best price for themselves. So what causes the problem is that the decisions that the separate divisions make may not be in the best interest of the company as a whole. So that is the problem. So how do we rectify it? There's no one solution to rectify it, but through transfer pricing principles within management accounting, there's some mechanism to at least find some sort of balance. So what we're going to cover here is a mechanism of how to work out the transfer price such that each division as well as the company as a whole will be satisfied or happy. Okay, without this, it will most likely not lead to such a situation. So that's the issue of transfer pricing. What price should the selling division sell to the buying division such that the selling division is happy, the buying division is happy, and at the same time, it results in the best results for the company as a whole. Okay, so that is basically the whole issue. So the way we do it is through working out a maximum price and working out a minimum price. Okay, so it's very important to understand when they ask you for the maximum price, whose perspective you are looking at it from. When you're working out the minimum price, whose perspective are you working it out from? Okay, so with transfer pricing, we're going to work out a maximum price. We're going to work out a maximum price. We're going to work out a minimum price. Now, the maximum price is from the buying division's perspective. Okay, from the buying division's perspective. So why does this make sense? The buying division wants to have a price in mind. So from the buying's perspective, they will want to know what is the maximum price they are willing to pay. Anything beyond that price, they won't buy it from. They won't be happy to buy it from the internal division. Similarly, for the minimum price is from the selling division's perspective. The selling division wants to know what is the minimum price they're willing to accept. Okay, so this is the selling division. Okay, so what is the minimum price they're willing to accept that will make them satisfied? Okay, so that is basically what we're going to be covering. Now, the minimum price is the one that can lead to 8 to 10 marks. The maximum price is like 4 max. So probably like 2 to 4 marks. Okay. So how do we work out the maximum transfer price? So the maximum transfer price is simply max TP equal. Okay. So maximum TP equal normal selling price or market price, normal selling price plus cost savings. Now, what is this? So the normal selling price is basically what is the price that the buying division can get if they go to an external party. Okay, so if they go into the normal market to an external party, how much would they pay? Okay, so that is the normal selling price. The normal selling price is just basically the market price, the price they would get, the price they would pay when they go to an external company. Okay, so that is the normal price. What is the cost savings? The cost savings is just basically, in some instances, when they buy out from an outsider, they may incur an order costs, some costs for ordering. Okay, so the actual price that they pay for a product is if they must buy from an external party, the actual price they pay for a product is the normal selling price they have to pay the supplier, plus the ordering costs that they have to incur. Therefore, we call it cost savings, because if they must buy internally, they will save on these costs. So the maximum price they're willing to pay is the price they would pay to an external supplier, plus the ordering costs that they may incur. Okay, so ordering costs, they generally use the term ordering costs, but it's basically any cost incurred to effect the purchase. Okay, so it's any cost incurred to effect the purchase. So the maximum transfer price is simply that. Okay, so that's why it's so easy, because it's just they'll give you the normal selling price, they'll tell you what is the ordering cost, and you just add the two together. Okay, so that is for transfer, the maximum transfer price. Now comes the minimum transfer price. Now this is a bit more to think about. So the minimum transfer price, like I said, could be like 8 to 10 marks. The minimum TP is equal to variable costs plus opportunity costs. Okay, so you always write this down: minimum transfer price equals variable costs plus opportunity costs. Okay, so we'll discuss what is variable cost, and we'll discuss what is opportunity cost. Now, what's important to understand, this variable cost, that variable cost, I'm just going to highlight it in red. So that variable cost, so this variable cost is the cost to produce for internal sales. Okay, so that's important to understand. So that is the cost incurred to produce internal sales. So what variable costs would we incur to manufacture a product for the internal division, for the buying division? Okay, that's important. What is opportunity costs? Opportunity cost is sales foregone. Okay, so what would happen? You have a so what would happen? You have a total capacity. Let's say you have spare capacity of 500, but you need actually spare capacity of 700. So if for order you need to produce 700, but you only have spare capacity of 500. So therefore you are short by 200. So if you decide to go ahead with this special order, you will have to forego 200 of your normal sales. So the opportunity cost is, in order to sell for this particular order, you would have to forego of your normal sales. So that is, so your opportunity is when you have to forego of your normal sales. So the way we calculate it, is opportunity costs. I'm going to put it over here. Okay, so opportunity cost is sales foregone. So if you have to forego any sales, then you have an opportunity cost. So over here, I'll say opportunity cost equals contribution margin foregone. Okay, so opportunity cost equals contribution margin foregone. Now, what do we know? Contribution margin equals sales minus variable costs. Now, this is the important aspect. This variable cost is not necessarily the same as that variable cost. So the variable cost in red is the variable cost to produce an item internally to your buying division. This variable cost over here, when you work out contribution margin for the opportunity cost, is the variable cost incurred for external sales. Okay, so that's very, very important to understand. I just want to get me a tissue quickly. I'm going to come back now, then I explain that further. In the meantime, if you have any questions, you can just think about it, you can ask me. Okay, so what would cause the variable cost in the red to be different from this variable cost? So what you must understand, when they produce a product, they don't make a special product for the external customer and a special product for the internal customer. It is exactly the same product. So therefore, the direct material, the direct labor, and the manufacturing overheads would be exactly the same. But the difference could come in two things. One, it could be that when they sell to an external customer, they incur a selling commission. Okay, so they have to pay a selling commission. So if they incur a selling commission, they will tell you the selling commission only happens for external sales. So therefore, the variable costs for this calculation would include an external selling commission, whereas this variable cost will not. Okay, but they're just selling internally, there's no need to incur a selling commission. Another example would be when they sell externally, they may package it in a certain way. So therefore, they incur packaging costs for external sales, but they may not necessarily incur packaging costs for internal sales. So this here may exclude packaging costs. Okay, so you might just look out for that. In some instances, the variable cost is exactly the same internally and externally, but in other cases, it is not. So it's very important to pick up whether some variable cost is only incurred for external sales relative to internal sales. Okay, so that's important to understand. So once again, the minimum cost, the minimum price is variable cost to produce internally plus opportunity cost. You only have an opportunity cost if you have to forego sales, if you have to forego external sales. So if you have to forego external sales, you will incur opportunity costs. The opportunity cost is equal to the contribution margin of foregone external sales. How do we calculate contribution margin? Sales minus variable costs. What's important to take note, this variable cost is variable cost incurred to sell externally. Okay, so that's important. So the question is, how do we know if we have an opportunity cost or not? We're going to have to do a capacity calculation. So basically, how do we work out whether we have spare capacity or not? We will say the following. We will say maximum capacity. Maximum capacity. Capacity. Okay. Less external sales. Okay, and this will give you, this will give us equal, this would equal available capacity. Okay, then we're going to say less required internal sales. So when you say available capacity minus required sales, if the answer is positive, we have a surplus. If the answer is negative, we have a shortfall. So we will only have an opportunity cost if there is a shortfall, because it means we will have to forego some of our external sales in order to meet our internal sales. Okay, so that is that. Do you have any questions on that, Alvina?
No, thanks. I understand. Thank you.
Okay. So this is the transfer pricing section that and I'm going to give you a question and I'll send it to everyone in the class that you have to cover, and then let me know if you have any questions that you need to, that we have to set up a one-to-one. Okay, so that's transfer pricing. Now I want to deal with performance management. For performance management, we are basically going to appraise the management, and we need to and basically generally is whether they get a bonus or not. Okay, so we need to know whether they meet a certain target or not. So there are different methods. The typical methods are return on investment, which is ROI, and the other one is what's it called now? Kind of thing, RI, residual income. Okay, residual income, called RI. Now we'll just use a formula to determine return on investment, use a formula to determine the residual income. Then we simply compare it to their target. Okay, if they meet the target, they will get their bonus. If they don't meet the target, they don't get the bonus. That's basically it. So what is the formula? So the formula for ROI is equal to controllable profit divided by controllable investment multiplied by 100. Residual income, RI, is equal to controllable profit minus WACC times controllable investment. Okay, so that is basically that formula. What you must know, that RI results in a percentage. RI results in a percentage. ROI, return on investment, results in a percentage, and RI, residual income, results in a value, like a rand value, a dollar value, or something of that nature. Okay, so this gives you a percentage, ROI gives you a percentage, and RI gives you a value. So one of the pros of ROI, return on investment, is that it's easy to understand. 18%, 20% relative to your target of 20% or 25%, whatever. Okay, where RI is a value. And so the pros of this is that it gives you an actual value, whether you're generating a profit or not. Okay, so that is the positive of RI. The negative of RI is that it's not easy to understand as it is easy to understand ROI. The negative of ROI is that it does not always incentivize management to make the right decision. Okay, because all they worry about is a percentage, so it may incentivize them to make wrong decisions or not the right decision. Okay, so that's basically pros and cons. Now, one of the most important aspects over here is to be able to calculate controllable profit and be able to calculate controllable investment. So the question is, how do we calculate? So what is the word controllable? The word controllable is you must only include for profit, income and expenses, and for investment, assets and liabilities that the manager can control. If he or she has a say in it, if he or she can have an impact and influence on the number, or they have control over the number, they make the decision regarding the number, then you must include it in the calculation. But if they have no control over the number, they don't have the say, they can't make a decision regarding the number, then it is not controllable, and therefore you don't include it. So for example, when it comes to investments, they will tell you that the manager must make long-term investment decisions like PPE and so forth. They must do working capital decisions, but they don't make decisions regarding long-term borrowings because the company's treasury function decides long-term borrowings. Therefore, what will be included in investments would be all the assets and whatever liabilities they control. So they will have that. Okay. When it comes to the controllable profit, now because there's a long-term borrowings, it will be finance costs. But because the manager can't control the long-term borrowings, you can't include the finance costs in controllable profit because they can't impact the interest expense. They have no control over it. They never decided what rate it should be, how much borrowings, and all of those type of stuff. So therefore, when you work out controllable profit, the income and expenses included in here must be income and expenses that the manager is able to control. He makes a decision regarding it. Similarly, for controllable investment, the assets and liabilities you include in here must be the assets and liabilities that the manager has control over. It's the manager that decides which assets to invest into, which liabilities to take out. Very, very important. Just important to take note, investments is calculated as follows. Investments equal total assets. So total assets means current assets plus current liabilities. I mean, current assets plus non-current assets minus current liabilities. Okay, so that's very important. So you must ask yourself, what of these total assets can the manager control? Whichever are the total assets he controls, you include it. Then you look at the current liabilities and you ask yourself, which of the current liabilities does the manager control? Whichever one he controls, you include it. Whichever one he does not control, you exclude it. Okay, very important. Another way to work out investments is just a rearrangement of a certain formula, because you don't know how they present the information. It would be total equity plus long-term liabilities. Okay, so you either calculate it like that or you calculate it like this. In most cases, you're going to be able to calculate it in that format, but sometimes they don't give you that and they only give you this. Then you must be able to calculate it like that as well. Okay, so when you look at this formula, which assets do they control? Which current liabilities do they control? That is what you include. For total equity, they won't be able to control any equity, so it's always all of that. And then it's generally all long-term liabilities. Okay, so just be aware of that. So that is performance management. So how you go about doing it, you just do this formula over here, and the word controllable is the most critical. Do they have a say? Can they decide? Do they make the decision regarding the income and expenses? Do they make the decision regarding the assets and liabilities, whichever one they have control over, whichever one they decide on, that is the ones that get included. Whichever one others make the decision on, that gets excluded. Okay, so just be aware of that. Okay, so that's all from my side. Tomorrow, I'm going to send out this recording with the transfer pricing and the performance management question you must cover. And then if you have any questions on it, then we set up a 1-to-1 15-minute session. Okay, that's all from my side. Is there any questions on your side?
No, thank you. That is, I understand.
Name?
I
Michaela?
understand.
Okay, you understand?
No
Michaela?
questions from me.
Okay. So I'm going to send this out tomorrow, and then I'm going to, I never covered a question on it. This is just a basic theory. So I want to see, I'm going to give you a question to cover. Then if you have any specific questions on your side, then, so you will cover it on your own, and then any question on your side, you can set up a session with me, then we go through it. Okay. So please make sure you're spending some time, like 60 minutes a day at least. Ideally, 90 minutes a day, but at the minimum, 60 minutes a day. And then weekends, give yourself 2 to 3 90-minute sessions. So don't work like for a straight five hours. Do like a 90-minute in the morning, 90-minute early afternoon, 90-minute late afternoon. It makes it more sustainable that way. So if you work in 90-minute sessions, you will see you'll be able to cover each topic 2 to 3 times. And then just make sure you also set some time aside where you work through 1 to 2 full exam papers from start to finish. Okay, because that you need to train to do for the final exam. Okay, and so as you plan to work out like a 60 to 90-minute session during the week, and 2 to 3 90-minute sessions each day of the weekend, before you make sure you do a high-level plan of what you're going to be covering, what day, which topic it is, which question exactly you're going to be covering. Had that planned out already, so that you can just, all you have to do is, and then also set aside a dedicated time every single day. Try to have the exact same time that you go and study. You're creating a habit so that it's easy for you. The moment you do different times, you're not getting yourself into a routine. So when it's difficult, when you're not in a routine, it's difficult to get to go do what you need to do. So if you build up a routine, automatically your body's going to switch into that mode. So that is why you want to do it every day at the exact same time. So during the week at a certain time, and in the weekends at other times. So, but have dedicated times over a weekend, have dedicated times during the week, so your body get into that rhythm of actually working. And then so when you work like that, you will, and you have your plan, you will be able to see whether you have enough time doing a 90-minute every day or 60-minute every day, and 2 to 3 90-minute sessions each day of the weekend. You'll be able to see whether you have enough time to cover each topic 2 to 3 times, plus 1 to 2 full exam question papers. That will give you the idea whether you're able to. And if it can't fit in, then you have to find out how you can squeeze in some more. So I had that first high-level overview, and then from there, plot yourself what you're going to study which day. Because remember, you're going to need some time to do some review. You're going to need some time to fix up certain areas. So think about that. So when you are within the 60 to 90 minutes, don't do like a 300 mark, don't do like a 100 marker, don't even do a 50 marker, do a 20 to 30 marker question. So you do transfer pricing, which is probably like 15 to 20 marks, depending on the question. So in 90 minutes, you can do a 15 to 20 minute plus a full review, and actually identify what you have learned and what you still need to fix up. Okay. So that's all from my side. Tomorrow we're going to go through, I don't remember what I said we're going through tomorrow. What did I say we're going through tomorrow? Okay, I'll just check the message, and then then I'm still going to do some of the recordings, and I'll send it to you by this weekend. And then next week, we're going to go into the revision. I'm going to select one question paper where we're going to work through over the Monday, Tuesday, and Wednesday. Okay. Okay, guys, thank you very much. If there's no other questions, we're good to go.
Okay, thank you. Thank you so
Thank
much,
you,
Faiz.
Faiz.
Pleasure. Bye-bye.